A number just crossed the trading desks that should make you stop what you're doing. Not because it's shocking, because of what it confirms. Bank of America just raised their gold price target to $6,000 per ounce. Not $5,000, not $5,500, $6,000 by spring 2026. That's not a forecast. That's a confession. When the second largest bank in America tells you gold is going to $6,000, they're not being optimistic. They're admitting that the currency system is breaking, that fiscal policy has gone off the rails, that the end game is here. But here's what they're not telling you. Here's what the analysts buried in footnotes and disclaimers. If gold goes to $6,000, and if the gold-silver ratio behaves the way it always has in every major monetary crisis, silver doesn't go to $120. It doesn't stop at $150. The math takes it to levels that sound impossible until you understand the mechanism. I am Ken Au. Welcome to the Vault. Today, Bank of America just validated the currency collapse thesis. And by the end, you'll see why $175 silver is arithmetic, not fantasy. Let me show you what Bank of America actually said, because the headlines are burying the real story. Michael Whitmer, their head of metals research, didn't just raise the price target, he changed the thesis. The report explicitly states that unorthodox U.S. fiscal policy is the primary driver. That's bank speak for the government is out of control. The United States is running trillion-dollar deficits. Debt to GDP is at wartime levels. And instead of cutting spending or raising taxes, they're printing money, monetizing the debt, debasing the currency. And when you debase the currency, gold doesn't go up because people are optimistic. Gold goes up because the denominator is collapsing. The dollar is losing purchasing power. And gold is the only asset that can't be printed, diluted, or defaulted on. That's the surface event. A major Wall Street bank raising their gold target to $6,000. Now let me show you what they didn't say, what they couldn't say, because if they said it out loud, it would trigger the very panic they're trying to avoid. Bank of America isn't alone in this call. JP Morgan has gold at $5,550 in late 2026 with a long-term target of $6,000 by 2028. Ed Yardeni is calling for $6,000 by year-end. Goldman Sachs sees $4,900. Morgan Stanley forecasts $4,500 by mid-2026. This isn't one rogue analyst. This is clustering. When every major bank revises their target upward at the same time, it means they're all seeing the same data, the same fiscal trajectory, the same central bank behavior. And what they're seeing is this. Central banks bought more gold in 2024 and 2025 than in any two-year period in modern history. Not because they're diversifying, because they're preparing. They're moving away from dollar reserves, away from treasuries, into hard assets that can't be frozen or sanctioned. After the US and EU froze Russia's reserves in 2022, every central bank on Earth learned the same lesson. Dollar reserves are not safe. They're a liability disguised as an asset. They can be weaponized. They can be confiscated. They can disappear overnight if you're on the wrong side of a geopolitical dispute. So they're buying gold, not as an investment, as insurance, and they're not stopping. Bank of America's modeling shows that central banks currently hold about 15% of their reserves in gold. The optimal allocation is 30%. If they move toward that level over the next few years, it represents sustained structural price-insensitive buying. This is where the system starts leaking. Now let me show you the piece that everyone is missing, the piece that changes everything. Silver. As of this morning, gold is trading around $4,500 per ounce. Silver is at $103.93. The gold to silver ratio is sitting at 48 to 1. That's the tightest it's been since 2013. Now here's the math that should terrify every institutional analyst who's still pretending this is normal. If gold goes to $6,000 and the ratio stays at 48 to 1, silver trades at $125 per ounce. If the ratio compresses to 40 to 1, which is well within historical norms, silver hits $150. If the ratio reverts to the 33 to 35 range that we saw in previous monetary crises, you're looking at $171 to $181. That's not speculation, that's division. Gold price divided by the ratio equals the silver price. The only question is which ratio the market settles on. And history has an opinion on that. In every major precious metals rally driven by currency debasement, the ratio compresses. It doesn't stay wide. It tightens, because silver is smaller, more volatile, and more leveraged to industrial demand. When gold moves 50%, silver moves 150%. When gold doubles, silver triples. This doesn't happen by accident. This is structural mechanics. But let me show you why this time is different. Why the ratio compression isn't just probable. Why it's inevitable. Silver is in a structural deficit. Not this year, not last year. 5 consecutive years. Total demand in 2025 was 1.24 billion ounces. Total supply, including mine production and recycling, was 1.01 billion ounces. That's a deficit of over 230 million ounces. 230 million ounces. That's the entire annual output of Mexico, the world's largest silver producer. Gone, consumed, not coming back, and the deficit is getting worse, not better. Industrial demand hit 665 million ounces in 2025. Solar panels consumed record amounts. Electric vehicles consumed record amounts. Electronics, semiconductors, medical devices, all consuming silver at accelerating rates. The International Energy Agency estimates that by 2030, the solar and EV sectors alone will consume half of global silver output. Half. That leaves almost nothing for jewelry, coins, or investment bars. And unlike gold, which sits in vaults and can be recycled efficiently, silver gets destroyed. It's used in trace amounts across millions of products. 20 grams in a solar panel, 2 ounces in an EV, micrograms in a smartphone. When those products reach end of life, the silver is economically unrecoverable. It's dispersed. It's gone. This is where things stop making sense. Now let me show you what happened on January 1st, 2026, the event that broke the global supply chain, the event that turned a deficit into a crisis. China implemented new export restrictions on refined silver. Under the new policy, only large state-approved companies can export silver, and only after obtaining special government licenses. Firms must meet 2 conditions: an annual production capacity of at least 80 tons and special regulatory approval. Those requirements effectively block hundreds of smaller and mid-sized exporters who have served as key suppliers to global industrial users for decades. Why does this matter? Because China controls 60-70% of the world's refined silver supply. Not ore. Refined. The 99 pure metal that manufacturers actually use. When China locks down 60% of global refining capacity, you don't create a supply hiccup. You create a supply crisis. And the effects are already visible. Since January 1st, inventories in London and Zurich have been draining. Lease rates spiked to over 8% on 1-month terms. When lease rates hit 8%, it means there's a scramble for physical metal. Industrial users are panic buying. They're locking in multi-year supply contracts at prices 20% above current spot. Why would a company pay 20% above spot for forward delivery? Because they expect future availability to be severely constrained. They're not speculating. They're securing survival. If they can't get silver, their production lines stop. Their factories shut down. Their workers go home. Someone knew this was coming, and they positioned for it. Let me give you the escalation loop, because once this starts, it accelerates. Each piece feeds the next. Loop 1. Central banks keep buying gold. They're not price sensitive. They're accumulating for strategic reasons: currency diversification, geopolitical insurance, protection against sanctions. That buying is structural. It doesn't stop when the price goes up. It accelerates. Loop 2. Investment demand follows institutional money. When Bank of America says gold is going to $6,000, retail investors pay attention. Hedge funds rebalance. Family offices allocate. ETF inflows surge. Right now, gold allocation in professional portfolios is only 0.5%. The optimal level is 30%. If institutions move even halfway toward that target, the demand surge is massive. Loop 3. Gold hitting $6,000 validates the currency collapse thesis. It tells the market that fiscal policy is out of control, that the dollar is being debased, that hard assets are the only safe harbor. And if that thesis is true for gold, it's even more powerful for silver, because silver has industrial scarcity on top of monetary demand. Loop 4. Industrial buyers panic. When China restricts exports and lease rates spike, manufacturers realize they're in a game of musical chairs. The music is still playing, but the chairs are disappearing. Loop 4. Industrial buyers panic. When China restricts exports and lease rates spike, manufacturers realize they're in a game of musical chairs. The music is still playing, but the chairs are disappearing, so they overbuy. They lock in multi-year contracts. They build inventory buffers. That buying pressure compounds the deficit. Loop 5. COMEX inventories drain. As industrial buyers take delivery and investment demand surges, registered silver in COMEX vaults drops. It's already fallen by tens of millions of ounces in recent weeks. If open interest stays elevated and deliveries continue, the vaults run dry. And when the vaults run dry, the exchange has 2 options: raise margin requirements or declare force majeure. Loop 6. Physical premiums explode. Like when dealers can't source metal and refineries are constrained by Chinese export bans, physical silver trades at massive premiums over the paper price. We've seen this before. In 2011, physical premiums hit 30-40% over spot. It's starting again. When the premium gap becomes undeniable, the paper market loses credibility. And when the paper market loses credibility, the whole pricing mechanism breaks. Each loop feeds the next. And once it starts, it doesn't stop, it cascades. Now let me show you the numbers that prove this isn't theoretical. This is already happening. Silver hit an all-time nominal high of $103.45 on January 23rd, 2026. That's not a typo. Silver has never traded higher in nominal dollar terms in history. The previous peaks were $49.45 in 1980 during the Hunt Brothers squeeze and $48.70 in 2011. We're now 112% above the 2011 high. And this rally is happening while industrial demand is supposedly declining and production is improving. That tells you the investment demand and supply constraint story is overpowering everything else. BNP Paribas suggested silver could climb as high as $100 per ounce by the end of 2026. We've already exceeded that in January. Bank of America sees silver averaging $60 for the year. We're at 103. Citigroup forecast $100 by March. We hit that weeks early. The forecasts are being shattered, not because the analysts were wrong about direction, because they underestimated velocity. They didn't account for China's export ban. They didn't account for lease rates spiking to 8%. They didn't account for industrial panic buying. The market is moving faster than the models predicted. And when markets move faster than models, it means something structural has changed. Let me walk you through the specific math, because this is where the thesis becomes undeniable. Gold is at $4,500. The ratio is at 48 to 1. That puts silver at $90.75. We're already at $103. The ratio is already compressed to 43 to 1. And we're not done. If gold moves to $6,000 and the ratio stays at 43 to 1, silver goes to 139. If the ratio compresses to 40 to 1, silver goes to $150. If it hits 35 to 1, which is where it traded in 2011, silver goes to $171. But here's the critical insight. In 2011, silver was not in a structural deficit. There were no export bans from China. Industrial demand was a fraction of what it is today. Solar panels barely use silver. EVs didn't exist at scale. And yet the ratio still compressed to 35 to 1. Today, the fundamentals are exponentially stronger. The deficit is real. The industrial demand is exploding. The export restrictions are in place. And yet, the ratio is only at 43 to 1. That's a mispricing. That's a dislocation. And markets correct dislocations violently. Now let me show you what the banks are really afraid of. Not high prices. They've navigated high gold before. What terrifies them is a market where physical delivery becomes the norm instead of the exception. The entire COMEX system depends on the assumption that most contracts settle in cash, that most buyers don't actually want the metal. They want the exposure, the profit, the trade. But when China restricts exports, when industrial users lock in multi-year supply, when lease rates spike to 8%, that assumption breaks. Industrial buyers don't want exposure. They want metal. And when 20% of the market demands physical delivery against a system leveraged 3 to 1, the math doesn't work. Total demand is 1.224 billion ounces. Total supply is 1.01 billion. That's a gap of 230 million ounces annually. The deficit doesn't get filled by hope. It gets filled by higher prices that either destroy demand or incentivize new supply. But new supply takes a decade to develop. Mine permitting, construction, ramp up. It's a 10-15 year process. And demand destruction? At what price does Samsung stop making phones? At what price does Tesla stop making cars? At what price do solar manufacturers shut down? The answer is much higher than $103, much higher than $150, because silver is a tiny fraction of the cost of the final product. A smartphone uses 50 cents of silver. If silver doubles, the phone costs 50 cents more. Nobody stops buying phones because of 50 cents. This is why industrial demand is inelastic. And inelastic demand in a deficit market creates explosive price moves. Let me show you the historical parallel, because this pattern has played out before. In 2010, gold was trading around $100. Silver was at $8. The ratio was 66 to 1. Then gold rallied to $1,900 by mid-2011, a 58% move. During that same period, silver rallied from $18 to $49, a 172% move. The ratio compressed from 66 to 1 to 38 to 1. Why? Because silver is more volatile, more leveraged, and more responsive to monetary crises. When gold moves on currency debasement, silver moves harder. When investment demand floods into precious metals, more of it flows to silver because it's cheaper per ounce. It feels more accessible. It offers more leverage. And in 2011, there was no structural deficit. There were no export bans. Industrial demand was half of what it is today. Yet silver still went parabolic. Now imagine what happens when you layer a structural deficit on top of a currency crisis, when you add Chinese export restrictions on top of surging industrial demand, when you combine COMEX inventory drains with spiking lease rates. The 2011 move was a warm-up. This is the main event. Now let me address the bearish case, because there are risks here. First, if the Federal Reserve takes a hawkish turn and raises rates or holds them elevated longer than expected, that's a headwind. Higher real interest rates make bonds more attractive relative to metals. Bank of America specifically notes this as the key downside risk. Second, industrial demand could face headwinds if recession indicators materialize. If manufacturing slows significantly, demand for silver and electronics and EVs could decline. Third, at elevated prices, there's always substitution risk. Companies will look for cheaper alternatives if silver becomes too expensive, though silver's unique properties make this difficult. Fourth, if investment demand reverses and ETF flows turn negative, that could create selling pressure. Fifth, higher prices incentivize mine production increases and recycling, which could eventually ease supply tightness, though this takes years. But here's the reality. We just hit $103, all-time nominal highs. And none of those bearish factors stopped it. Industrial demand is supposedly declining, production is supposedly improving, and yet silver hit $103. That tells you the investment demand and supply constraint story is stronger than the bearish factors. It tells you the market is pricing in something bigger, something structural, something that doesn't reverse when the Fed tweaks interest rates or when manufacturing slows for a quarter. The market is pricing in currency collapse, and when the market prices in currency collapse, it doesn't care about recession risk or substitution efforts. It cares about scarcity, it cares about the deficit, it cares about the fact that you can't print silver. Let me walk you through the timeline, not when it might happen, when it's happening. Week 1. This week, Bank of America publishes the $6,000 gold forecast. Institutional money starts repositioning. Hedge funds rebalance. Family offices allocate. The narrative shifts from gold might go higher to gold is going to $6,000. Week 2. Retail investors follow institutional money. ETF inflows surge. Coin dealers see demand spike. Premiums start widening. Physical buyers realize the window is closing. Week 3. Industrial buyers see the price move and panic. They accelerate forward purchasing. They lock in multi-year contracts. They overbuy because they're terrified of being caught short when Chinese export restrictions tighten further. Week 4. COMEX inventories start draining faster. Open interest stays elevated. Deliveries increase. The exchange issues warnings about potential delivery delays. Lease rates spike again. Week 5. Physical premiums hit 20% over spot. Dealers limit orders. Mints announce delays. The paper-physical gap becomes undeniable. Week 6. Someone declares force majeure. Could be a refinery, could be a dealer, could be an exchange. Once the precedent is set, the entire system unravels. We're in week 1 right now, maybe early week 2. The Bank of America forecast is the starting gun. Everything else is cascade. Now, let me show you the final piece, the piece that makes this entire thesis undeniable. The gold-silver ratio doesn't care about forecasts. It doesn't care about opinions. It cares about physics. It cares about geology. It cares about the fact that gold sits in vaults and silver gets consumed. When gold rallies because of currency debasement, the ratio compresses. It always has. It always will. Because silver is the poor man's gold. It's the accessible alternative. It's the asset that retail investors buy when they can't afford a full ounce of gold. And when the ratio compresses in a deficit market with export restrictions and spiking industrial demand, it doesn't compress to 50 to 1. It compresses to 40 to 35 to 30. At 40 to 1 with $6,000 gold, silver is $150. At 35 to 1, it's $171. At 30 to 1, it's $200. Those aren't targets. They're mathematical outcomes. If Bank of America is right about $6,000 gold, and if the ratio behaves the way it always has, silver isn't going to $120. It's going to $150, $175, maybe higher. Let me give you the open-ended warning. If this continues, price won't be the problem. Availability will be, you won't be asking, should I buy silver at $150? You'll be asking, where can I find silver at any price? By the time Bank of America raises their silver forecast to match their gold thesis, the metal will be gone. The dealers will be sold out, the premiums will be 40% over spot, and the industrial buyers will have locked up every available ounce through multi-year contracts. The window is closing, not in months, in weeks, maybe days. And when it closes, the market will discover what the banks have hidden for decades. There is far less physical silver than the paper market promised, far less than the ETFs claimed, far less than anyone believed. The system is built on a lie, and Bank of America just validated that lie. They didn't mean to. But when you tell the world that gold is going to $6,000 because of unorthodox fiscal policy, you're admitting the currency system is breaking. And if the currency system is breaking, silver doesn't stop at $103, doesn't stop at $150. The ratio will compress, the deficit will widen, the Chinese export ban will tighten, and the math will do what math always does. It will force reality onto the market, whether the market is ready or not. Bank of America called $6,000 gold. They think they're forecasting. They're confessing. And if they're right about gold, the math on silver isn't shocking. It's inevitable. You've been given the information. You've seen the pattern. You understand the mechanism. The ratio is compressing. The deficit is widening. The export ban is tightening. And $6,000 gold is the catalyst that breaks everything. By the time the headlines catch up, it will already be too late. The metal will be gone. The premiums will be insurmountable. And the people asking, why didn't anyone warn us, will be the same people who scrolled past this video. The signal is being sent right now, this moment. The question is whether you're paying attention or whether you're waiting for permission from analysts who still don't understand what's happening. Bank of America just gave you the permission. $6,000 gold, currency collapse, fiscal insanity, it's all confirmed. The math on silver isn't shocking, it's arithmetic, and arithmetic doesn't negotiate.